Thank you for giving me this opportunity to speak. It was really interesting to listen to Venu. I have been listening to him always, and we have worked together. So, great insights on the equity side also. So, coming to the fixed income update, today's I'm going to present on the what expectations one should have from the fixed income markets as you go ahead. What could be. So, we have divided that into four parts. What should be the returns expectations? What are the risks involved in the process? What are the regulatory changes which will affect the retail investors? And IT is a very important part today. So one slide is on the technology changes that are taking place. So we go into the first part, that is the returns part. So, inflation has been declining not only on the domestic front, but globally also. In fact, on the domestic side, earlier it used to swing between, say, 5-6% to say double digits. So, from the time the Monetary Policy Committee was, appointed, the MPC has been successful in bringing down this inflation in a very structural manner. It has declined to, around 6% and below. The medium-term target for MPC is to have the inflation around, bring it to around 4% plus minus 2%. So if for 3 quarters, the inflation remains below 2, or for 3 quarters it remains above 6, then the MPC actually explains why that has happened. So, for the medium term, the inflation target is around 4%. So inflation expectations are coming down. So as your inflation is declining, even your interest rates are declining, not only on the domestic front, on the global front also. The chart shows clearly, the some of the places like US, Japan, Eurozone, the rates are close to zero. In our case also, the topmost line, it shows the 10-year yields, from double digit all the way it has declined to below 6%. So the rates are also declining. This shows the movement of 10-year yields along with your repo rate. See, all the rates have been declining, whether you look at PPF rates or you look at tax-free bonds or you look at the FD rates. All these rates have been declining, and similarly, the bond yields also are declining. And the point that I'm trying to make here is that the returns expectation also have to decline over a period of time. There was a time when we used to get 12% in PPF, double-digit kind of returns. Currently, we are, we have declined to around 7% or so. So as in a structural manner, the interest rates are actually declining, and hence we have to adjust to those declining interest rates and pare down our returns expectations. So we go to the next thing, that is the risk. So even if now people want to continue with the risk kind of they want higher returns, then they have to be ready to take some risk on the higher side. So there are a lot of type of risk, different types of risk, credit risk or liquidity risk. So we are just going to discuss the duration, the credit risk, and the liquidity risk as far as fixed income is concerned. So SLR, these are the three pillars on the fixed income. Any fixed income decision starts with the risk management, and one has to, always be conscious about, that there is no risk as far as the portfolio is concerned. In equity, if a stock has actually fallen, there is some hope that at some point in time when the economy recovers, probably that stock would again recover. But in debt, once the paper defaults or is totally out of flavor, it becomes very difficult to exit those positions. So safety is of paramount importance as far as portfolio is concerned. Any good organization which has processes within the organization would have safety as a priority. Second parameter is on the liquidity front. So on a good day, you can trade in the fixed income markets, but on a bad day, it becomes very difficult because in corporate bonds we have OTC market, which is a brokered market, which is on the phone. It becomes very difficult to trade in that kind of environment. So on a bad day, the debt would give you jitters. So it's always better to be in liquid and good papers so that we are a pass-through vehicle as a mutual fund and we are able to liquidate the portfolio on time. And obviously, once you follow safety and liquidity, the risk-adjusted returns always follows. So that is the third step. This is basically showing you the duration risk, because this is the product positioning. There is a overnight fund and a liquid fund at the bottom end of the chart. Those who don't want to take any risk or those who want the principal protection would be in an overnight fund. But as you go higher on the ladder, you go into dynamic bond funds or the credit funds or the gilt funds, you will be facing, the duration risk or the credit risk depending on the fund that one has invested. SEBI has actually, the regulator has put the, different ladders for each and every category. So this is showing that. So here we have taken three categories on the fixed income side. How they have performed in the last 5 years. Why we have taken 5 years? Because investors beyond 5 years, those who tell us we are there for 7 years, 10 years kind of thing, we normally tell them to invest in equity for a longer period. So that's why we have taken a 5-year moment. Now, if you look at the this chart, the bottom line is the liquid fund returns in the last 5 years, and they have been marginally above 6%. So here you don't face much of volatility, but your returns are lower. You look at the topmost line, you look at the gilt fund, gilt category, you will get the best returns, highest returns, but you will have to, because you have to look at the standard deviation also, the volatility in the NAVs and other things. So there you will be facing the duration risk and other things. But there is a line in between these two, which is a 3-year product, a short-term bond fund kind of a category, which where the returns are very closer to, the gilt fund returns, and the maturity is also between 1 to 3 years kind of a product. So on a risk adjusted basis, this category turns out to be the best between these A, B, and C, all the three products. So what have we learned from the recent credit catastrophe? Any lessons learned? So we are always telling investors that always look for process-driven investment philosophies. Invest in schemes where there is some, or organization where there is some process, because once the process is in place, then things would be smoother. And don't just look at blindly at returns. Look at risk-adjusted returns. Look at what the portfolio the fund is carrying. If you have the ability to invest in a complex kind of a product, fair enough. If you don't understand, then stay away and take the right advice and then invest. So coming to the decision-making process, as I mentioned earlier, also those who are investors who are not very comfortable with the credit kind of products can always invest in gilt type of products. And mutual funds today are investing, having a lot of facilities for investors. You can invest via, if you don't want to invest lump sum, you can do via SIP. You can even withdraw your money as a systematic withdrawal plan. That process you can use. So there are a lot of facilities, look at those facilities first, look at the fund manager track record, look at your investment horizon, and then take any decision, where you want to invest. So the third step, which I wanted to discuss is on the regulatory changes. So coming to the first point, in the last few years, the regulator has made a lot of changes. In the last 2 decades that I've spent in this industry, I have seen regulator coming out with a lot of changes on the fixed income side, which are really helpful for the retail investors. So minimum percentage to be invest as per the scheme name. So there is, when there's a scheme name, there is an objective attached to it. For example, a gilt fund, you would invest only 80% has to be invested at any point in time in the gilt category. Similarly, you have a banking and a PSU fund where 80% has to be invested in banking and PSU as a category. So SEBI has mandated that, and for the whole industry, and no one can deviate from that. That's good for the retail investors. Then introduction of full portfolio. There was a time, I remember, when people used to disclose only top 10 holdings in the portfolio. So you wouldn't know what is the balance 90% of the portfolio. So today, one can actually look at the full portfolio on a monthly basis, which is put up on the respective sites of each and every AMC, and there is full disclosure. And I believe as we go ahead, there are talks of that being available on a fortnightly basis as far as debt is concerned. So investor who wants to know what is happening intra-month in his portfolio would also know that. So coming to the third point, minimum 20% liquidity or a 7-day load. See, what happens in case of liquid funds is there's a lot of investors come in and move out on a daily basis. So say around 10 to 20% of the portfolio, depending on each fund house, what type of retail base or institutional base they have. Some big clients keep coming and going out. So there was a step-up load which was introduced, for 7 days. As if the investor just wants to come in and move out on the same day, he has to pay some load. So otherwise, he has to stay invested for 7 days. Because if he was coming out and going out on a daily basis, that was affecting the retail investors. So this is something good that the regulator has done. And on the similar lines, minimum 20% liquidity in the liquid fund, that is investment in treasury bills or cash. So that is also very helpful, because if the fund manager is having 20% of his portfolio liquid, then to that extent, whatever the inflow outflow happens on a daily basis, he's able to manage smoothly. So next point is on the introduction of common pricing. So there was a time when, suppose there are three fund houses, A, B, and C, all are having similar paper in the portfolio. A would value it at 100, B would value it at 99, and C would value it at 101. It was all perception based. There was a time like that. Today we get our prices from a third party, and all the three AMCs will have to value it at the same price, and that would come out in the NAV at the end of the day. So bringing a same kind of a pricing from a third party was a very important step, and it was required. Next is on the mark-to-market pricing and amortization. In liquid funds, we all know there was amortization earlier. People would up to papers up to 2 months, 3 months would be amortized on a regular basis. Currently, we are having everything mark to market. So what used to happen? Suppose your portfolio is at 6% YTM, and suppose your market yields come down to say 5%, then investors would react differently. Or suppose if your portfolio is at 6% and your interest rates go towards 7%, then some SEBI investor would redeem from this fund, and the guys who are remaining would get penalized. Similarly, if your interest rates move towards 5%, and there is and still your portfolio is amortized at 6%, then there is a lot of profit hidden in the portfolio. So some savvy investor would come and eat away into the profit of some other retail investors. So now with all the papers having mark to market, whether 1 day, 1 week, everything, that type of problem is not there. And the last thing is on the duration caps across products, that we discussed earlier. I'll just take you to the slide. This is the slide, where I'm saying that the regulator has defined the duration caps. Overnight fund is overnight only. You can't buy a 7-day or a 10-day paper just because it is short in an overnight fund. You have to buy 1-day paper. Similarly, for a liquid fund up to 90 days, or say a short-term bond fund will have a duration between 1 year to 3 years, and that is same across AMCs. It's not that somebody else can have something else. So it is across AMCs. So these type of, now it is more clear to the investor at the time of investment that whether he is investing in a product which is run as a 1 to 3 year, or but there are certain categories like dynamic bond fund or a banking PSU where the regulator has not defined any caps on the maturity, but otherwise most of the products are as per that. So we go to the next part, that is the ease of transaction. We cannot ignore today what IT is doing. It's playing a very key role. There was a time where investors would come with a checkbook and they would wait for their statements once they invest, or if they have to put a redemption, they would face some problems. Today, at the click of one mouse, you can do that. You are just sitting at home and you go to the respective sites, and you just have to log in, whether you want to invest and you want to do your KYC online. Some good AMCs are doing your KYCs online. Your bank account is getting connected and you are able to invest. These type of facilities are given by other fintech platforms or by exchanges, and investors are able to participate in the mutual fund through all this. So basically a faster turnaround time there. The investor doesn't have to wait for long, whether he wants to invest or he wants to redeem his money. So technology has played a key role in that. So investing in debt funds, rational considerations. So here what we are trying to say is that at different point in times, the debt funds will perform in a different way. Suppose we are in a falling interest rate scenario, the longer funds tend to perform well. And if we are in a rising interest rate scenario, the liquid funds or the overnight funds will protect your capital at that point in time. So the investor has to know that that what is the risk involved, and accordingly keep his returns expectations realistic. If he comes in a long fund, when he is in looking at the past 1 year return or 3 year returns, and thinks that he's going to make similar kind of returns, then there is a problem. So he has to look under what scenario he's investing, what level he entered, and in which product he's going, and what is his requirement exactly. So similarly, there are other things which debt funds are offering. At the end of 3 years, there is tax efficiency. You get the indexation kicks in, and one is able to get better returns from all that, compared to say a fixed deposit or other instrument. So one has to always compare at the time, because there is ease of liquidating also. Suppose you buy a FD, a 3 year FD, you are not able to liquidate that, whereas or you may have to pay a penalty to liquidate that. But in case of debt funds, it is quite smooth, and one can always do that. So this is we are in a COVID-19 kind of an environment, and what should the investors do? So COVID-19 is a rare event and is expected to impact the savings habit and consumption patterns. So central banks, we have seen all over the world taking a lot of necessary action to support the markets. And as we go ahead, the economy is expected to bounce back once we get the COVID-19 kind of solution. So therefore, we would urge investors to stay invested, not to panic. And because of the volatility in the market, over a period of time, things will get stabilized. That's all from my side. If you have any questions, I'll be happy to answer.
Hi. That was very interesting. We have a couple of questions from the audience. So Sunil wants to know, would you recommend banking and PSU fund for 3 years?
Yeah, for 3 years, I would recommend a banking and PSU fund if it is for 3 years at this point in time. Okay. See, although the yields have come off in a big way, what has happened because of the credit episodes in the last few years, a lot of investment has come in the banking and PSU category, and there was a huge demand for banking and PSU papers. So the yields have come off in this category. But if it's a 3 year kind of a horizon, then one can always expect to be in these type of schemes.
Okay. The next question is from Sumant. He wants to know, is the dynamic bond fund suited to retail investors, and is it a good way to minimize risk?
Dynamic bond funds, one has to be very clear, because see, what is your investment horizon? Because here you are depending on the fund manager or the fund house. As I mentioned some time back when I was showing the ladder, there is no cap which SEBI has mentioned on the dynamic bond fund category. So the fund manager can run a 1 year maturity or a 10 year maturity. So if your objective is very clear, if you are there for 3 years or something, then you have those 3 year products. If your objective is for 5 years, you have those 5 year products. So one can look at those products also instead of dynamic bond fund.
Okay, so thank you. You really covered the entire gamut of what has been happening recently in this space. What is the outlook? Thank you so much. That was really insightful.
Thank you, sir. In the end, I just want to say one thing,
please,
to the investors, that never lose your capital. That is rule number 1. And rule number 2 is never forget rule number 1.
Okay, fantastic. Thank you.